All right, Chapter 3, Measuring Business Income. Revenues, you've already determined from the first midterm, are increases from selling either goods or services. Either goods, whether they're manufactured by you and then sold to distributors or wholesalers, or they're finished goods that you buy from a manufacturer or a wholesaler and then you turn around and sell them to the general public. Expenses are everything that has been expended and incurred, whether it's spent in cash or not, in order to produce those revenues. All right? So one of the underlying principles in accounting is matching. You want to capture all of the expenses on the income statement that generated all of those revenues, whether or not you've paid them or not. So cash is not really the focus. The focus is, did you incur an expense? So employees is a good example. Employees work every day. They earn money for those endeavors. You only pay them, well, I don't know of a business, I'm sure there is, they don't know of a business that gets paid every day, but you pay them every other week for the most part, twice a month, once a month, something along those lines. So if the month end falls in midweek, you need to get all of the wages that are earned up to the end of that month into the period in which they worked and earned revenue for you. Okay? Matching rule. The cost basis. We use historical cost, the cash basis of accounting. You as taxpayers, employees, you work on a cash basis. The IRS doesn't tax you on your wages unless you've received them. That's the way our tax works. You're a cash basis taxpayer. You don't get to deduct expenses unless you've paid for them. All right? There's a notable exception to that is if you put it on a credit card, which is kind of an odd little rule that Congress put it in there. So you can charge stuff on the last day, business expenses on the last, or health expenses on the last day of the year, and even though you're not going to pay for it until the next year, you get to claim it on your last year's taxes, but I digress. Businesses, in order to be able to provide an accurate picture in the financial statements of the true performance in the period that is represented, have to do accrual basis accounting. All right? So accrual basis is recognizing revenues when we've earned them. The earnings process is finished. You've entered an agreement with a customer. You have fulfilled your part of that agreement. The customer now owes you what you agreed upon. All right? If we're going to present revenues on an income statement, we need to capture all of the related expenses that you had to incur in order to generate that money. So for that, what we've been looking at in chapters 1 and 2 especially, is transactional entries. We have been making journal entries as transactions occur. Beyond that, at the end of the month, there are certain adjusting entries that need to be made to those ledger balances, just like we did on the first midterm. We took all those transactional journal entries, posted them to account ledgers in the form of T accounts, and then produced a set of financial statements. Well, there are a series of adjusting entries that are required to transform those account balances into a much more accurate picture of what has actually occurred in the period that we're measuring. So revenue recognition is that there's an arrangement between you and your customer. You have fulfilled that by either delivering a product or service, whatever was contracted for. Your price is fixed and determinable. We know how much revenue was generated in that agreement. And then the last part, the Securities and Exchange requires that collectability is reasonably assured. Many, many rules in U.S. generally accepted accounting principles are there, and we got lots of them. I think I mentioned in maybe the first couple of days that U.S. GAAP consists of 34,000 pages of rules and pronouncements and interpretations, and some of them are industry-specific interpretations. There's rules that only apply to the software industry. There's rules that only apply to the movie and entertainment industry. There's a bunch of rules. Many of these rules were developed and adopted in response to some abuse that has occurred where the Financial Accounting Standards Board, the FASB, has determined that this is misleading. And that last one is one of them. You can't enter into a sales contract with your Uncle Carl that doesn't have 2 pennies to rub together on the last day of the year and then claim that as revenue. Because Uncle Carl doesn't have any ability to pay you. And yet, that has occurred in the past. You go find somebody off the street and say, here, sign this $1 million contract for the delivery of 10 new trucks. Okay, not a problem. And then claim it as revenue. And then the next year, yeah, of course, you got to claim it as a bad debt, but that's next year. This year, you got the revenue. So they've added this collectability has to be reasonably assured. If the auditors come in and start doing some confirmation of your receivables, or if they're in, because a lot of times the auditors come in and do financial statement field work in February timeframe, even as late as March. And so by that point in time, if you haven't collected on the invoice that you wrote back on New Year's Eve, what's going on? Why haven't they paid you? Okay, so they've added that. All right, expenses similar to the revenues. There is an agreement that you are either going to purchase goods or services. Your vendor has delivered what you have agreed on. The price is determinable once again, and you have used those either products or services from your vendor to generate revenue. In other words, you incurred those expenses to directly make money. Okay? So as I indicated, we must make adjustments. The balance sheet needs to list all of the assets and liabilities and stockholders' equity at the end of the day on the last day of the period. Based upon nothing but journal entries that were transactional in nature, they don't. And a good example is on your midterm. Prepaid rent. You paid that rent up front, $4,500 as I recall, at the beginning of January. Well, at the end of the January, you have occupied those premises for a month. But yet, all $4,500 is still listed on the balance sheet as an asset. That's an account that needs an adjustment. Because you really only have 2 months left that are prepaid, not all 3. Okay? So this is the same creative designs that we had from Chapter 2. So this is a continuation of the same exact trial balance as of the end of July. So they've got prepaid rent, they've got office supplies, they've got accounts receivable, they've got some unearned design revenue in there. This is unadjusted. We have not made any adjusting entries. So adjusting entries there are 4 types of adjusting entries required, or possibly required. You won't, every month, you won't have all 4 kinds. You could. There are 4 types that could be made to make sure that you present all of the revenues that were earned and all of the expenses that were incurred. Okay? They're either deferrals or accruals. And when we get to talking in the details about it all, they're all either cash has been received or paid by you, but revenue has not yet been earned. If you received the cash but you haven't done the revenue yet, it's a deposit of some sort. Or you've paid the cash but you haven't yet incurred the expense, prepaid rent. Okay? Those are deferrals. You paid the cash up front, but you need to recognize the expense later. Accruals are the opposite. No cash has changed hands. You have not yet paid the utility expense, going back to the first midterm. But yet, you have used the utilities in the month to generate your revenue. You turned the power on. You used the telephone. That's an accrual. That's an expense that has not yet been paid, but yet you have used those services or goods from your vendor in order to generate revenue. Same with revenue. You have earned the money. You have completed the earnings process. You have delivered the goods or services that your customer has contracted, but you haven't billed them yet. All right? The earnings process is complete as of the end of the period, as of midnight on the last day of the month, but you haven't generated an invoice for it. A great example is the revenue recognition for a company that I used to be the chief financial officer for. It's called Pacific Gas Turbine Center. We repaired and maintained jet aircraft engines for airliners. Our revenue recognition policy was that the engine had to pass what is known as test cell by the last day of the month in order for us to recognize the revenue in the month. All right? What a test cell is a big block, cement block building that you take a jet aircraft engine into and you bolt it to the ceiling. And then you hook up a bunch of instruments and some fuel lines and all sorts of stuff, and you power it up inside a building. And it makes an enormous amount of noise. It's really kind of a lot of fun. You can go in there and you can stand up against the wall with your ear protectors on, and the wind is just screaming by. You can feel it vibrating your bone marrow. I mean, it's really a lot of fun. Test cells. It had to pass. I mean, you'll be comforted to know as passengers and airlines that we actually test the engines before we put them on the airplane and fly you to Des Moines, Iowa. We test it first in the aerospace business. We had an engine, and I could hear this test cell running from my house. I had an apartment that was, it was 5-6 miles away. And I knew when the engine, especially if there was a little cloud cover, I knew when the test cell was running. So I heard the test cell running at the end of the month, especially the end of the quarters. You know, the end of March, the end of June, the end of September. I used to notice that the test cell used to run until 3-4 o'clock in the morning sometimes. We were right on the other side of a fence from a Marine Corps base that had a lot of helicopters and stuff like that. And so the neighbors used to always call the Marines because they assumed they were making the noise, because we were just this nondescript little building. Nobody ever knew what we were doing inside. And so they used to always call them for noise. It was hilarious because they would turn around and call us because they knew we were the ones that were causing havoc. And so I went up there one day and I said, I walked in at midnight and I went, what's going on, guys? Oh, we're still testing the engine. I said, it hasn't passed yet? No, it's, second stage compressor is still wobbling a little bit. We're going to have to go in there and tweak it. I went, okay, shut it down. Time's up. CEO was really mad. He was in my office the next morning screaming at me. Because an engine is $2-3 million worth of an invoice. That's a substantial amount of revenue that I wasn't going to allow into the quarter. I said, listen, it didn't pass. We're not going to play games. We were a subsidiary of a publicly traded company. And I said, we can't do this. And thankfully, the vice president of engineering backed me up on it because he was really mad. So that's an example of an accrual. If it had passed test, it takes weeks to get an invoice out for all the little pieces and parts. So we didn't have an actual invoice, but I would have estimated it and taken it as revenue. All right? So here's the 4 types of entries that could happen. We're going to, and they're either, once again, an accrual or a deferral. Now, adjusting entries, I'll need to note, every entry always has at least 2 accounts, right? There's always at least 1 debit and 1 credit. Adjusting entries always affect at least 1 balance sheet account and 1 income statement account. All right? In the case of deferrals, you have already either received the money, in which case it's listed, if you haven't earned it yet, you've received a deposit down, it's listed as a liability. All right? A customer deposit, unearned revenue, some liability. And we received an asset, cash. Once we earn that process, we need to allocate that revenue between unearned revenues into the accounting period where we earn it. So that's reducing a liability and increasing a revenue. In the case of the engine that passed test on the last day of the month, that's recognizing an asset, debiting accounts receivable, and recognizing the revenue. All right? So that's an accrual. So this is an accrual down here. This is a deferral. Deferrals are related to cash has already changed hands. All right? In the expense part, we are allocating costs between more than one period. Prepaid rent. So we're going to reduce an asset and increase an expense, which eventually reduces stockholders' equity. So we're reducing an asset and we're reducing stockholders' equity. That's a deferral of an expense that we've already paid for. We paid the prepaid rent when we signed the lease. Right? And then lastly, recognizing unrecorded. This is going to increase an expense, that's going to be our debit, but it's going to increase a liability of some sort. Interest payable, taxes payable, wages payable, utilities payable. All right? Okay? That's an accrual. So we have an accrual here, and an accrual here, and a deferral here, and a deferral here. In these 2 cases, cash has already changed hands. A customer has given us a deposit on revenue that we're going to earn sometime in the future. And now we've earned it. So we need to make the adjusting entry. We have spent the money on rent or a long-term asset like sound equipment, and we now need to allocate it to the expense for the period. We have earned the revenues but not yet billed the customer and the customer hasn't paid us, or we've accrued the expense but yet we have not yet paid our vendor for whatever goods and services they have rendered. All right, so those are the four types. Depreciation is a type 1. It is a deferral of an expense that we have already paid for. Depreciation is the systematic allocation. We've got a whole chapter on this after we get through second midterm on property, plant, and equipment, long-term fixed assets. Depreciation is the systematic allocation of the cost of tangible property. Buildings, delivery trucks, automobiles, airplanes, ships, desks, computer equipment, chairs. It's the systematic allocation of an asset that we're going to utilize for more than one period. Right? In the case of a building, you use it for 30 years in some cases. So that's a type 1. These are paid in advance. We've paid the cash for the building or the sound equipment or the computer equipment, and now we're taking the expense. Okay? That's lowering an asset of some sort, and it is increasing an expense. So we're going to debit the expense account and credit the asset. Prepaid rent. 1 month of the, as I recall in this example, we paid 2 months rent, $3,200 when we started this design company. 1 month has gone away. From your midterm, it was $4,500 for 3 months, so we would be debiting rent expense and crediting prepaid rent. All right? Here's the journal entry. Here's the debit and the credit. It is reducing that 2 months of rent that we put down on July 3rd. At the end of July, we've now occupied the office space for 1 month, and it's leaving a balance of 1 month for the month of August, the next month. And then come September, I imagine we'll be writing a check every month from that point on. Yes, sir?
So, but why is the expense under a
debit? Expenses are almost always debits because debits are negative stockholders' equity. It reduces net income, reduces retained earnings, reduces stockholders' equity. So expenses are always.
So if it goes up, the expense goes up?
The expense goes up. It increases the expense account. Yep. Just like if we had just paid rent straight up on the first of the month, okay, and paid cash for it. All right? Supplies is another one. You buy supplies, you put it in the closet, but sooner or later somebody goes in there and uses it. So you need to go through and look to see what supplies have been consumed throughout the month and make an adjusting entry. That's a prepaid expense. So you go in there and you count how many office supplies we got left over. And then you reduce that balance down to what you have left on hand. So they go down and they take a balance, they take an inventory, and they determine there's $3,660 of supplies left. Yes, sir?
But does the office supplies go to assets on the balance sheet?
When we bought it initially, yes. Yep, it's just like any other inventory. So it's an asset initially, and then we're going to reduce it by the amount that we consumed. Because if we've got $3,660 left in there, but we had $5,200 available, we must have consumed $1,540 of them. All right? This is another deferred expense. Property, plant, and equipment is a little different in that we leave the asset account alone. It's not like supplies where we write them down to the current balance. We leave the historical cost on the balance sheet so that the readers of the financial statements will know what we paid originally for all our assets. Because fixed assets are kind of strange in that they don't always decrease in value. Sometimes they increase. Land goes up, paintings go up, buildings go up, office apartment complexes go up in value. But we still systematically depreciate the cost over the period of time that we generate revenues. So we use what is known as a contra account, a negative asset account. In this case, it's accumulated depreciation on office equipment. So we determined that the $16,320 for the month of July, $300 is depreciation expense. And like I said, we got a whole chapter, I think it's chapter 6, it might be chapter 9. One of those chapters after the second midterm is on calculating depreciation. All right? For right now, for purposes of this chapter and certainly this next midterm, I will always give you the amount of depreciation. I'll tell you, the depreciation expense for the month is $500, right? So it's $300 here. That's a debit to depreciation expense. That's lowering stockholders' equity. And a credit to a contra asset account, accumulated depreciation. Okay? The second type, so that was all type 1. That is a deferred expense. The second type is an accrued expense. This is expenses that have incurred, but you haven't paid for yet. No cash has changed hands. Both expenses, accruals are always no cash. Deferrals, cash has already been received or paid. So, we've borrowed some money. We now have some interest that has accrued. We haven't paid the interest yet, but yet we owe it to whoever we borrowed the money from. We owe wages to our employees. We owe taxes to the government. We owe the utility company for the utilities that we've used. They're not like your cable company or your cell phone company. They don't bill you in advance. Those two do, by the way. You pay a month in advance for your cell phone and your cable. All right, so we now we've used the expense to generate revenue. We've used the wages. We've used the utilities. So we need to then increase a liability account and decrease a stockholders' equity account expense. So we're going to be debiting the expense and crediting some sort of payable. Wages payable, taxes payable, interest payable, utilities payable, or accounts payable. All right? So we have unrecorded wages, $720. The employees have worked the time, they're owed the money, but they're not going to get paid till sometime next month. So this is a debit to wage expense and a credit to wages payable. Increasing a liability with a credit and decreasing a stockholder's equity with a debit. Increasing an expense account. We estimate that income taxes are going to be $800. This is what you owe on the net income that you've earned during the month. Whoops, what did I do? There we go. That's a debit to income taxes expense and a credit to income taxes payable. Type 3 adjustment. This is cash has been received, but you've not yet earned it. So in the case of our design company, you remember they received some cash to design a brochure, I believe. But they haven't yet designed the brochure. It's a deposit. This is commonly used in the law field. You place attorneys on retainer. I hope you never have to do so, but that's what you do in law. This is how the airline business works, right? You've all flown someplace. When you made a reservation, did Delta just say, okay, we'll see you on the 15th, you can pay us then? No problem. When you get to the airport, just bring the cash. No, that's not the way it works. You pay for it up front. That's a liability to the airline until you actually board that crazy aluminum tube and go rocketing through the upper atmosphere at hundreds of miles an hour, right? At that point, they've earned the revenue. Do you need to go or no? Okay, go ahead. All right, so this is lowering a liability with a debit and crediting a revenue account, which increases net income, increases retained earnings, increases stockholders' equity. So we're lowering a liability and we're increasing a stockholders' equity. And then, so here's performance of services paid in advance, $800. So that brochure, we've now earned, they gave us $1,400 to design it on the 19th. By the end of the month, we've done $800 worth of that work. So we've eaten into the retainer by $800. We still owe them $600 worth of work. And so it's a debit, lowering the liability, unearned design revenue, and a credit to design revenue. This is the way magazine subscriptions also work. You pay for a 3-month subscription to Sports Illustrated. Sports Illustrated doesn't get to recognize that revenue until each and every month when they actually send you the magazine. That's the way it works. All right, then the last type, type 4. And this is accruing revenues that you have earned. This is the engine that mythically passes test, which occasionally they did, because from that point on, they were real careful about shutting that thing down at midnight. And they, sometimes the engine does pass. Oftentimes it passes. All right, so we need to record the revenue. So we're going to record an asset, increasing a balance sheet account, and we're going to increase stockholders' equity by recording a credit to revenue. So unrecorded revenue, $400. This has been earned. We haven't yet billed the customer. So it's a debit to accounts receivable and a credit to design revenue. All right, how do we do all this? There's a tool called the Accountant's Worksheet, and you'll be using it a lot over the next few weeks. The Accountant's Worksheet takes the unadjusted trial balance. Here's every account, or the T accounts in the case of your midterm, every account with its unadjusted balance. So in here, there are prepaid expenses that need to be reduced. There's unearned revenues that need to be reduced. There's depreciation that needs to be taken. And what you do is you make adjustments in order to properly reflect the earnings that have gone on during the period. All right? So these are all the adjustments that we just went through. So the prepaid rent was the first one. That was the A entry. And when we get to doing problems on Thursday? No, next week, Monday. What is today? Wednesday, yes. I've lost track. Wednesday. So next Monday, we'll do problems on the board using the accountant's worksheet. And eventually, I'll switch to doing them in Excel. They're just easier in Excel. Plus, I want to start preparing you because you've got that 40 points for that Excel project, that Excel assignment. And that's part of, it's an accountant's worksheet that you create from a blank Excel spreadsheet, all right? So that increased rent expense, and you can see that rent expense wasn't on the trial balance because we hadn't incurred any rent yet in the month. It was all prepaid. And then it reduces, there's the other half of it, there's the credit. It reduces that asset account from $3,200. Then you get an adjusting So everything with a debit balance, you add any debit adjustments and you subtract any credit adjustments. Anything with a credit balance, liabilities for instance, you deduct, you subtract any debits, and you add any credits. So like the reduction here of unearned design revenue. That takes that $1,400 down to $600. And that'll give you an adjusted trial balance. Now you're ready to do your financial statements. You'll split them between the income statement accounts, all of the revenues, all of the expenses, and the balance sheet accounts. And then you can prepare from the accountant's worksheet your income statement, your statement of retained earnings, and your balance sheet. So it's a tool that is utilized in order to make the adjusting process simple. It's not simple, simpler. Okay? Does that make sense? All right. So these are the adjustments that we made. You post those to the debit and credit columns and the adjusting columns there next to the unadjusted trial balance, and then carry them across. Questions? We'll do lots of examples come Monday.